Hi everyone, in this video we'll be beginning with the chapter number 24 of CMT level 2, analyzing sentiment in derivatives market. Before watching this video, make sure that you've checked the previous chapters. If you haven't, then I've linked it in the description box below. So in the previous chapter, we saw how we interpret sentiments in the stock market, and in this video we'll be seeing how to interpret the sentiment in the futures market or options market, or let's just group them together and say the derivatives market. Derivatives are instruments whose prices are based on the value of an underlying asset, right? So if I'm trading the Nifty options or Nifty future, then my underlying is basically the Nifty index. If I'm trading the S&P 500 options contracts, then my underlying is the S&P 500 index. So that's what it is. A derivative basically derives its value from something which is underlying. It is a contract between two parties based on the value of a specified asset. The price of the derivative is determined by the value of the underlying asset. As an example, equity option contracts are typically based on the value of 100 shares of an underlying stock. The value of the option is determined by a variety of factors, including a relationship between the exercise price of the contract and whatever the market value is. In this chapter, we'll be learning about them. So, the most important sentiment analysis tool, which is used by most of them, is known as the put call ratio or the PCR. PCR is the put call ratio. So, trading of calls and puts in the options market can offer insights into sentiment. Call options are often used to speculate on price gains. Put options are also or used to speculate if you think that the price will basically go down. Some traders buy puts to benefit from price declines. Other traders use put options to hedge their portfolios against the risk. One indicator that provides information about sentiment is the put call ratio. The PC ratio compares the volume or the open interest of puts to calls. So the volume or the open interest of the puts are compared with that of the calls. Okay. So this is what is basically the calculation or the meaning of the put call ratio. Figure 24.1 shows that the PC volume ratio for equity options traded on the CBOE, okay, fell sharply. 24.1. Look at this PC. This is the put call ratio of the equities, and you can see that in February 2018 there was a very sharp decline in the PC ratio, right? So what does the big decline basically mean? The increase in the PC volume ratio coincides with the price decline in the index. That indicates that traders were buying puts either to benefit from further declines or to protect their portfolio against the losses. So if you have an increase in the put call ratio, then you can see that the basically when there's an increase in the put call ratio, that means that people are buying puts more, and when there is a decline in the put call ratio, then people are less likely to buy puts and more likely to buy calls. While there is no way to determine exactly why the puts were being bought, the fact that put options were so popular is a sign of increased fear on the part of the traders. The direction of the change in the ratio can provide all that is needed for analysis of the PC ratio. While the specific levels of the ratio can be important, the changes in the ratio reveal the sentiment of the buyers. An increase in the PC ratio will always indicate an increase in put volume, and that reversal a higher level of bearishness. This is an indicator that measures sentiment through action rather than surveys, and for that reason, it could be important to consider. Detailed analysis of the ratio could include applying additional indicators such as moving average, Bollinger Bands, and etc. Obviously, combining the PC ratio with other sorts of index. Here we have the S&P 500, and here we have the okay. So when you saw that the PC ratio declined drastically, what happened in 2018? In 2018, actually, it went up, right? So that's how you are going to basically look at the charts. Like most sentiment indicators, the PC ratio is interpreted in a contrarian manner. Rising ratios indicate a higher level of bearishness among traders. It is considered to be bullish in the short run. Falling ratios indicate a reduction in put trading relative to calls, which means that it is bearish in the turn, short run. Got it? Futures open interest. Analysts can also monitor the open interest in futures. Open interest is the total number of outstanding future contracts that have not been settled by an offsetting trade or by delivery. So the number of open positions which haven't been settled yet, they are basically known as um, that is basically known as open interest. For each buyer of a futures contract, there must be a seller. From the time the buyer and seller open a contract until it's closed, the contract is considered open. Changes in the open interest offer insights into the sentiment of traders. In general, an increase in open interest indicates a new money entering the market. This would indicate the trend is likely to continue. So, if there's an increase in open interest, that means that more people are interested, more positions are being opened, which means that the trend is more likely to continue. But then if the open interest declines, that means that the money is leaving the market. That means that the trend is going to reverse. If open interest is steady for some time, the trend is likely near a reversal point. But steady open interest is early warning sign that, but it is not for sure that the now the it's going to change, but it's just an early warning or an caution or an alert signal. This interpretation requires knowing the direction of the trend in both price and open interest. These general tendencies can be summarized in table. It is also possible to determine which group of market participants is likely causing the change in the open interest, and that will be studying from COT report or the commitments of traders report. Now look at this particular look at this particular table. The direction of the trend is right now up. There is an uptrend in the market, and the open interest is also increasing, which means that the price is also rising and the open interest is also rising, which means that the trend is going to continue, which means that the uptrend is going to continue. Then again, the price is uptrending and the open interest is decreasing, which means that the uptrending is now coming to a halt and it can be um, it can reverse most likely. The price is going down, there's a downtrend going on, and the open interest is increasing, which means that the downtrend is likely to continue. The downtrend is going on and the open interest is decreasing, which means that the downtrend is likely to reverse. Very simple stuff. Next, let's come to the COT data or the commitment of traders data. So this report is published on a periodical basis and it is very, very essential, and people use this data when they are taking any trades, whether in stocks or futures or any sorts of instrument, including the currencies or forex. The Commodity Futures Trading Commission is a federal agency charged. They ensure transparency in the markets and they require large traders to report their positions on a weekly basis. Although the CFTC uses various classifications, the reporting categories are often consolidated by the data providers and can be shown in the 24.3. So this is gold futures COT net positions data. This is the COT report, right? It is being plotted below. So keep that in mind. Now let's try to read about it. The lowest line in the bottom pane of the chart shows the net open position of commercials. This line, net open positions. The most bottom line, this one which you can see, this basically shows the net open positions of commercials. These are the producers and industrial users of commodity who use the markets to hedge their exposures. So while we are speculators and we just trade in, let's say, gold for the sake of it or just to make money by using speculation, but the actual gold suppliers or the actual people who are selling or buying gold, who are the actual dealers of gold, they are basically the commercials, and the first from the bottom line depicts their buying and selling activity. In the gold market, commercials include mining companies and jewelers. Jewelers are obviously the consumers, and the mining companies are the producers. The top line in the bottom pane of the chart, this one, shows the net open positions of large speculators, which can be hedge funds, commodity, CTAs, etc. So the topmost one is basically showing off the hedging people and hedge funds and stuff like that. The most bottom one is basically showing us the suppliers of the same. Small speculators, basically the open interest that is not accounted by commercial or large speculators, is shown in the middle. So middle one is basically the people like you and me, right, who do not have that much of capital but who are actively participating in trading. Okay. Commercials tend to require access to physical commodity and can use futures to maximize revenue and reducing costs. If a mining company, for example, believes prices are likely to fall, they can sell futures contracts to benefit from the high prices. As the contracts become due, they will be able to deliver the metal. Because they know the market's fundamentals, the commercials are generally viewed as the smart money in the market. Obviously, since they are doing this on a daily basis, right? They are actually physically dealing in these commodities, so they have sort of knowledge which we might not have. This means that based on the data in the figure, an analyst using COT could expect prices to rise given increasingly bullish, less bearish position of the commercials as represented by the rising line in the bottom pane. In fact, the setup of COT data at the right edge of the chart appears similar to the pattern seen in late 2015. See this? 2015 is over here. So look at the gold prices and look at the data. You'll be able to find the correlation between the same. Here you can see that it's going up, which means that sellers are more interested in taking the prices up, and the price actually went up as well. So that's the way you are going to correlate both of them. Each position in the futures market, there must be an opposite side. So obviously for every open long position, there is an open short position, right? So that's how every time there is a buyer in a market, there is also a seller in the market. One reason that large speculators are selling as the price fall is many fund managers and CTAs are trend followers. Their strategy is to buy when prices are rising and sell when the prices are falling. Their behavior as trend followers is irrational and offsets the requirements of the commercials. Small speculators are often wrong in the futures market, and their positions are not usually significant as compared to the large players. Okay, that was the COT data, or the Commitment of Traders report, and it is published every week by the CFTC. Volatility. Expectations of future volatility can also be a sentiment indicator, and obviously, like we have discussed in the VIX chapter and implied volatility chapter, we know that CBOE volatility index basically talks about the volatility that is present in the market. And by seeing the kind of volatility that is actually present in the market, you can basically make decisions in your trading, right? So obviously, it's also known as the fear index. If there's a question in the exam which says that what is the fear index, then you will tick on the option which says the VIX index. The name refers to the tendency of the VIX to move up as the price of the and the S&P moves down. VIX is a calculation designed to produce a measure of constant 30-day expected volatility in the US stock market. So I don't even have to go through VIX since we've already discussed in extreme detail, but you can look at it, right? Whenever there is a big dump, like during the COVID, the price dumped on a very rapid rate. There was a big sharp dump, and at the same time, there was a high spike in the VIX index. Another shortcoming of VIX is the fact that it cannot be traded directly. VIX is tradable with options, futures contracts, options and futures, and other derivative products. These markets provide another tool for analysts to gauge sentiment. While VIX is certainly the most popular volatility index, there are additional exchange calculated volatility index. While not all of these are tradable, these indexes could be analyzed for the market sentiment. So you can't just be like you want to buy VIX or you want to short VIX. You can just use the chart of the VIX to make decisions in the other areas. Okay, figure 24.5, let's see that. Okay, these are all the volatility index. You can see what the tickers are. These are the symbols, and you can see all of these volatility index. So every particular index has its own volatility index. So you can, if you're trading in that index, then it's also nice to correlate it with the, you know, it's also very good to correlate it with the volatility index. So you can see we even have euro volatility, yen volatility, British volatility. So these talk about the volatility of the index. And then we have GVX and gold futures. This is the gold futures and this is the gold ETF volatility. So all of the indexes have their own volatility index. So that's it with analyzing the sentiment in the derivatives market.